Rising interest rate will always be good for commercial bank. This is what we hear in the news media, in the financial mainstream media, but the reality is it's not always as black and white, because when we look at today's news where Moody downgraded some of the major commercial banks in the US just because they fear that their profitability is going to be squeezed further, because now they're paying a little bit higher interest on the deposit. So back in the March, when we saw SVB and First Republic and Credit Suisse collapsed, and the reason was because the depositors were not getting enough interest on their deposits, so they were taking that money out and trying to put this into the money market funds, which was giving them in the north of 4% interest rate. In order to stop that fleeing, they started paying more interest on the deposit, but that interest is coming at a cost. And that cost is actually eating their profit margin when it comes to reporting their earnings. So if you don't know how the banks work, they pretty much work based upon the interest spread, which means they lend on a longer term interest rate and they borrow at a shorter term interest rate, and they make money between the spread on that. So when that spread is going to be squeezed going forward, their profit margin is going to be hurt as a result of that. And this is what Moody is looking into those commercial banks' balance sheet and predicting their earnings, their profit margins is going to be significantly impacted. And that's not the only reason why we see more bank failures going forward, because we have to couple that with commercial real estate crisis. We know that in the US there is a big crisis going on in the commercial real estate segment, not only on the office buildings but also the multifamily residential complexes, where typically the lending is done on a short-term basis. So that, let's say if the commercial owner take the loan 2 years ago, now they're going to basically come to the bank to refinance that loan, and typically now they're going to get much higher interest rate compared to what they got 2 years ago. Let's say they got 2 years ago 2% interest rate, now they're going to refinance at 6%. That's a major difference in terms of the interest rate hike, which will actually reduce their cash flow situation. And when bank will reassess their net operating margin, which is basically cap rate in the commercial real estate, they will reassess their value a little bit lower, which means they will only give them maybe 60 or 70% LTV compared to what they gave them before. Then it means the commercial real estate owner will have to consider either putting more cash into the project or consider selling it. So this will trigger a massive, in terms of crisis, to basically hit commercial banks in terms of how they lend money to the commercial real estate segment. So we haven't seen that huge issue in Canada yet. Eventually this will hit Canada as well, but so far we haven't seen those major crises in Canadian banks yet. Maybe because the Canadian consumers are not very much concerned about getting lower interest rate on their deposit, even though the GIC is offering much more interest on their return. So anyway, but RBC actually published a report where they're also predicting a slump in the bank's earning, primarily because there was a reduction in the credit growth and the merger and acquisition activity, which is reduced 77% compared to last year this period. Coupled with all these US impacts that we are seeing, I think the banks are going to be under pressure going forward. And we will see major issues in the commercial real estate segment first before it hits the residential real estate market. So what do you make out of this video? Basically what I'm telling you is, if you hold bank stocks or you are going to buy bank stocks, be careful, because these banks are going to get a tougher next 6 to 12 months period because of all these issues: reduced margins because of interest rate spread, real estate crisis in the commercial segment, as well as slowness in the credit growth and the merger and acquisition activity. So all of these things combined with most probably a recessionary period will also going to squeeze their performance from a stock perspective. So be careful if you're buying bank stock or going to hold them, because things are not looking good. Anyway, let me know what you think. Put your comments down below and I'll see you in the next video. Thank you.